Welcome. I'm Jim Farish of jimsnotes.com. As we've been teaching for more than 15 years about trading, been doing this professionally for more than 30 years. And one of the key things that I always come back to is that you need education in order to become a better trader. And I'm going to cover a little bit of education tonight, and then we're going to cover some real-time situations. But going to a little bit of a podcast type formation along with live webinars to give you a little bit more focus on how education is important, but also to be able to see it in real-time situations. So I'll start out tonight with some educational type layouts, and then we'll look at some real-time situations with some sectors of what's going on in the market relative to that and how that impacts us really going forward as traders. So putting this in perspective, I think one of the things I wanted to start with tonight is this saying that I have on my desk and I've had for many years, is that trading is not a matter of being right or wrong. And for me, many times that's where I think we tend to mess up our brains a little bit in the fact that we feel like we always have to be right. Well, if you put yourself in that situation with the market is the only thing that's right 100% of the time, because it's a voting proxy for everybody who's out there trading. And as a result, they're going to be a composite on each bar as to what they do or don't do relative to the markets on any given day. So when you set yourself up to be right or wrong, I think that you really set yourself up for psychological damage relative to trading and investing, because what you find yourself doing is that when you're wrong, you beat yourself up, and when you're right, your ego gets blown up a little bit, and we all struggle with this on a day-to-day basis. And what you want is a more even keel about your approach to trading, and not approaching it as a right or wrong proposition, but more about making the right decisions or choices relative to how you manage any given position. So to say it more succinctly would be that it's about making more money when you're right and losing less money when you're wrong. In other words, you're managing the events of the market on any given day relative to any given position in order to let your profits run and cut your losses. To me, that's what trading is really about. It's not a matter of being right or wrong. It's a matter of the management of the process, so that when you are right, your gains are greater than when the market goes against you and you have a repercussion of losses. So the total is always on the positive side and not the negative side. So that's really the key of this. So if we get off of the focus of being right or wrong and making money, and focus more on the process and doing it well, in other words, looking at whatever our strategy is and conducting that strategy with discipline and finesse and getting better and better at the process, we would become a better trader. And as a result, our profits will be better, and we will be much more even-keeled or happy, if you want to dare to use that word, relative to how we trade. So all of that said, you want to put into place risk controls, and you want to balance out how you approach the market on any given day. And I've got Twitter up here, and let's just use this as an example of what we're talking about, in the fact that we'll go down here to this bottoming type range that we have on Twitter, and then you get the breakout here. You can see this is back in February, and this is a position that we still currently own relative to Twitter within our portfolios. So if we look at the trading range and the breakout, so the entry of this position, you can see is right here around $40.50. So we'll put our entry at $40.50. We buy some shares. Our stop on this would be a violation or a break back below the bottom of this, and you can determine how much risk you're willing to take. Obviously, the bottom is down here around $36.50, or that would give us about a $4 risk factor, or 10%. relative to the position. So I'll put 36.50 in here, and you can, and we'll come back and adjust this as based on what you're trying to do. Now, when we originally posted this, we were looking at this to be an intermediate term trade, which means we're looking at 9 to 18 month holding periods, which means we're looking longer term. And in order to hold positions longer term, you want to give more breathing room to the position. Thus, that $4 doesn't really bother me because I can manage that as I go along if the trade works or does not work. Now, if you want it more as a trade, you can come in here, right in this position, right in here, and put your stop in there, which would be around 39.25, which would be about $1.25. So you have an option, but that would be, from my position, that would be a trade. So you're not looking at that or based on the original objective. You're now looking at this from a trade, and a trade is 0 to 13 weeks. So you're being much shorter sighted in how you're going to approach the actual position. So the stop is determined by the timeline that you have established relative to the trade and what you're looking for in the setup as far as going forward. So we took this trade originally at that. The target for this trade would be the height of this trading range, which is 35 to 40.50. So that's $5.50. You add that on the top, that would give you a target of 45.50 up here on that. So we would have a target down here of 45.50, and that's how the trade would set up coming into it. And you can see that it gapped above that on earnings, and then it traded sideways, moved up, it's traded sideways, and moved up slightly, and then traded sideways some more at this point. And we could talk about further about what you can do with this sideways transactions and how you could trade into some of that to add trades, but that's a conversation for another time. But managing this is putting into a place risk controls. And when we talk about risk controls, all we're talking about is a stop, evaluating at the target, and evaluating our entry. So controlling the entry process on gap runaways. You don't want to chase stocks. We're talking about managing the stops, not just when you buy it, but as the trade goes along. So you're always managing the risk parameters of the trade, and you're setting up parameters or processes or rules, if you dare use that word, to manage the risk of every position within your portfolio so that you're not getting yourself out on a limb to the point where you can't manage the risk of the trade because your angst or your emotions are hung out there to dry. So manage the position on a day-to-day basis as it unfolds. And with Twitter, you can see that as it moves up, you're now going to manage that position, and you want to let it run. Remember, we talked about not being right or wrong. When we're focused on being right, we get greedy. When we're focused on being wrong, we panic or have fear. And those two emotions are definitely engaged fully when you approach the market with that right or wrong focus. When we look at managing the risk of the trade from the opening of the trade, then we take on a different mindset really to the market. Our focus now becomes how do we manage the position that we have on a day-to-day basis versus being right or wrong with the position. Now it becomes money management and not right or wrong syndromes with the market, because if we can get rid of that one key focus, I think it really helps you in a lot of ways change the psyche of how you approach the markets. Now, if you own this position, let's go back to this and look at, we were talking about you could trade off of the position. So we own it. It gaps higher, and we would bring our stop up to around 45 in here, 44.50-ish, and on the stop. We let it run up, and you can see that it actually comes down. It creates a low pivot, and then it starts to trade a little bit sideways. And we could trade this out of the break off support here, so we could actually enter on this bar and trade it upside, and we would get stopped out back in here around the $50 mark, and then we let it trade sideways. It breaks out. You can trade that, and you would still be in that trade on a sideways move. So you can always add to and take away from long-term positions by trading off of them based on setups. Those are just basic pattern setups within the position. So don't get caught up in the fact that you have a long-term trade that you're not able to trade off of that. Use the tools that you're given in the markets on a day-to-day basis, not only to look longer term, but also to look in a micro-term format so that you can capture the things that are there. So the risk controls are very important. Trading to me really comes down to what you think, why you're trading, what you're trying to do. It's getting introspective in some ways to focus on yourself. It's focusing on, why am I doing this? What do I think about the markets? And I'm going to bring some of that back in as we go through some of the current issues that are going on in the market right now. But using each of these tools on a daily basis really is what makes you a better trader, a better investor. And the other thing is, never feel, or if you find that you're telling the market what to do, to me it's a sign of nervousness. It's a sign of becoming a raging neurotic. It's a sign that you lack confidence in the trade. And, if Twitter starts to fall apart and I find myself telling the market what I want Twitter to do, the market doesn't really care what I think. The market is going to do what the market does. And I'm going to follow things that I think are important to me as, Twitter unfolds. And I'm, down here we have RSI on the pink, which you can see at the very end of this is at 40.12. That becomes a concern to me anytime that relative strength dips below 50. And you can see here's a period where relative strength dipped below 50, and you can see what Twitter did, and you can see that it tested support. And that was important to me as to whether or not Twitter held support within that declining relative strength. Now, as relative strength declines in here again, does it hold support, which right now it is, just around the $50 mark. It's just above it around 50.20. And as long as it maintains and holds that, even if RSI dips, if it breaks key support levels along with the relative strength dipping, and then you can see that time segment and volume is dipping. If we had cash flow on here, we would look at that as well. Is the cash flow momentum into the position declining as well? All of those are important components relative to what you're seeing on a day-to-day basis within the markets, because they help you make better decisions about exits and risk control. You want to hold the position as long as the position's working, but when, it's the quote by Theodore Roosevelt that I use a lot, that when the horse dies, dismount. When the position dies, get out of the position and move on to something else. If it reverts back to the upside, you can always go back, but don't allow your nerves to overtake the logic behind what you're doing. So if you're going to play the game, know the rules and play by the rules. And that's, the rules are created by you as an investor, as a trader, and the rules are what you find or deem to be important along the way. So let's take what we just talked about and let's go back and look at some current events that are going on in the markets right now. And, every Monday, which is when I'm recording this, I come into the market week really outlining sectors that I think are important for various reasons. So what I'm going to do is I'm going to try to take some of these, set them up with the parameters of how you set up a trade, and then how do we manage the risk of that trade going forward. It's always easy, like in this Twitter situation, to look back and say, here's what we did, here's how we did it. But it's also equally important to know if you're looking at something, I'm just going to put up energy right now, XLE, how are you treating it right now? And this trade, you can see, has set up off of all of this noise that it's created along the way. And there's been various trading opportunities relative to XLE. The first that we actually traded was out of this kind of double bottom. It came up, and we got stopped out on this bar right here. It came all the way back down, did kind of a V bottom with an ascending triangle over here that put us back in the trade that we're in right now, back over here. So this is a case in point where we traded the bottom. It came up, hit against resistance, and because this was a trade setup, being that it was 0 to 13 weeks, our stops get tighter on shorter time frames. So we take an out of the position in here. It goes down, comes back, sets up as another trading opportunity, and we take another trade. So you take this trade and you make a couple of percent on this trade, and now we're in this trade, and maybe we're up another couple of percent or whatever the returns are. But we get so focused on this that we forget that this is a result of managing the process. It's a managing the process of the trade. And so let's set up the trade that we're in right now. And you can see that the breakout was right in here along this 78.30-ish level. So we'll put the entry right here at 78.30 was the entry. Our stop on this was right back in this level of around 76.50. And so we have our stop, we have our entry, and our target would have been the height of this move, which was about $3.50, which puts us at 81.80-ish, which is right up here in the 82.50-ish range, which is a target that we chose at 82.50, which corresponds to this previous high. And that's where the target is right now, which we've hit the target, which means that we will tighten up our stop. And our stop is right here right now at 80.50. We want to take out that level, and that would net us a profit on the entry of about $4.20 or about 5.5%. But it's a result of managing the entry and the risk of the trade. We're not out of the trade yet, and the trade is actually setting up to add to by the fact that it's created this pennant or triangle pattern. And if this were to break above the 82.50 with some volume, then we would add to our position. Now, if it breaks below 80.50, we'll stop out of our position, and that means we're managing the risk of the trade going forward. Now, back away from it, and you have to come into the trading week asking yourself, what do you believe to be true about energy? And so you have to make your list. What do I be true? You know, the way I start out is I want to write 10 things. I start out always trying to write 10 because it makes my brain work a little bit harder. You know, but 10 reasons to like oil or like energy. You know, why do I like energy? And I will start to make a list of 1 to 10 of why I like energy. And I can say, you know, that I believe that, excuse me, that oil has leveled out in a trading range, and it actually broke out of the trading range. So I think oil has an upward bias. I would look at it and say that the institutional money likes it, and it thinks it's a value play. So you see money flow increasing inside of here. So when you got money flow rising, then that's a positive relative to the institutional buyership. And, you know, you could go through, I'm going to go through all 10, but you get the idea. Is you start making a list of why do I like energy, and even break it down further. You know, are there parts of energy that I like more than others? You know, do I like XOP, which would be the exploration pieces? Do I like IEO? You know, do I like the refiners? You know, what do I like inside of oil? And I can write them down, and they're part of my list of 10 things that I like about energy. And even if I like oil, or I can like natural gas, I can like gasoline, UGA, whatever I like inside of here, I make it a part of my 10 things, and I create that list, and I look at that list throughout the week as to whether or not they're unfolding within a sector that I like and that I own. So because confidence is there relative to what I'm looking at, I'm getting better as I go along in owning the energy sector. And then if you look, let's just look at a couple charts to go with it. OIH, which looks almost identical to XLE in its unfolding relative to what we're seeing there. Gas and exploration, XOP, you know, this was outperforming, but now it looks very similar to the chart of XLE. And then IEO, which is production, has, you know, very similar, but it actually broke out and is consolidating. So you got a little bit different look here in that in energy and the others, we had this kind of breakout and then consolidation at the end, and as it didn't break higher, this actually broke higher and is consolidating here, and you can see the 200-day moving average. But I like this consolidation format much better in that it broke out of that V bottom, held up here and now could continue higher. But so you look for the pieces that you like, and then you dig into that as to what is working inside of this. And for me, what I uncovered in here is that I got earnings coming out on 4/24 today, or 4/30, which is Thursday. Today's Monday, 4/27. So these companies are going to announce, Tesoro will announce, but I can see what's going on here, and I can track this into earnings and say, is it, if I want to trade it into earnings, then it needs to rally and break higher. If I want to wait for earnings and then trade the results of earnings, then I would look at where were my breakout setups relative to earnings coming in it, and I would look at right in here on around the 90.50 level for that to break above that on earnings, and then look to buy it. If it gaps above that, then I got to come up with some solution of how do I deal with the gap, which would be to let it play out a little bit. So you set up the trade according to what you're looking at. And, if I look at Valero, you see a similar type pattern. You got a little bit of a cup down here on the formation of the low at the bottom end of that range that it's trading in. But it's going to come out on Thursday with earnings as well. And MPC, which is another one that I like in there, which is Marathon Petroleum, has another very interesting setup. All three of these have setups that are a little bit different in that this is an ascending triangle or wedge. And so if it breaks out coming out of earnings, that's a positive. If it breaks down, obviously that's a negative. But use the setup within the energy that we see right now to set up and manage the risk of those trades. So you're looking at everything relative to my entry, exit, and target, and then you're looking at risk controls within that. You're not trying to tell the market you're not trying to tell the market what to do. You're acting on what you believe, which is, again, it's reining in the emotions. It's bringing the process back so that you become much better at acknowledgement relative to the risks that we all run in the markets on a day-to-day basis. So I think it's very important that we continue to track along and see how things are unfolding in the market. Now, another part of the market that has been positive has been technology, and you can see tech, this set up on an ABCD type pattern, which you see here, the ABCD. So the market comes down, bounces, comes down, bounces, and then it broke out of that pattern on the upside. So that gave us an entry down here around 42.20, and you can see it's trading at 43.20. And you could own XLK into that. Your stop would be ratcheted up right now to about right here around 42.70, and you would let it run as long as you can. And again, this is a trade. It was on a short-term horizon look into what's going on right now in tech. And, so to take it even further, you would look inside of tech and you would look at software, but you're looking for pieces that are driving this. And you can see very clearly the setup here. But think about this. If I'm coming into this a couple of weeks ago with the mindset that I like tech, it's setting up nicely for a breakout. Tech breaks out before software, but then software follows through with a breakout. I have more confidence in taking the IGV trade relative to that breakout. And if I wanted to, I could actually come over here and trade all right, now we got the IGV holdings. And I would look at the pieces, and you can see Oracle. You can see each of these setting up, and you can see VMware was part of that breakout that led software higher. You can see Utilimate software. Symantec is coming off of its lows and starting to break through there. But you get the point, is that what you're looking at is what was the leadership 5 or 6 days ago on these breaks higher. So you can either trade the ETF at the IGV, or you can dig down and say, who are the leaders that are going to take us higher? And you can see this gap higher on Microsoft earnings actually, excuse me, set up for an entry way back here. So this bar right here shows you the entry. Now, we would have known that this was earnings day right here. But if we wanted to own that trade into earnings, it gave you a perfect setup to own the trade into earnings. Then you're part of the gap higher, and now your stop is maybe down here at 47 or 46.25. But you now are in that position with a very nice gain. So use the tools again. Use the strategies. Don't get caught up in the emotions of what you hear on CNBC or what you read in different scenarios, or trying to catch the most of everything with every trade, be so right that you're just, you're the prima donna of trading. Get focused in on what is transpiring, because it's much easier to visualize the market when you have beliefs that are yours versus beliefs that are someone else. A network, you can see the same thing here with the setup off the downtrend and the breakout. I mean, it's very clear sometimes after the fact how things set up. But it's also clear by the fact that we were looking at XLK, which is the tech sector as a whole, in a very similar pattern. It broke out. So for IGN to break out at the same time isn't a shock. It's actually something that you would have confidence in because of the fact of what you've been looking at. The same with social media, in that we've seen this breakout of this big consolidation way back here in the March timeline. You can see it broke out, consolidated, broke out of that, and now has started to run very nicely on the upside. But there's the succinct leader within tech was really social media, and you got a nice run there along with the run out of internet stocks. But the internet was more of a laggard. It was more the social media that took the flyer to the upside. And you can see that FDN, very similar, got into a consolidation pattern and then broke to the upside. So there definitely were things within tech. There's still things within tech. The only thing that's concerning within tech right now is the semiconductors, which cannot, I mean, that chart is ugly. There's no real two ways about it. It's just ugly. We had some positions in semis. We got stopped out of these last Thursday and Friday. And now we have to look and see how much of an impact semiconductors have to tech going forward. But that's the other leg of the stool as we go into this trading week, looking at tech, liking it overall, but having a cautious eye towards semis and whether or not that will have a true overall impact going forward. So I think you get the point just with some live things of what's going on. A couple of other things these are worry issues that you have to kind of take notice of relative, especially on today's trading, with what happened in the markets across the board. Very interesting. Biotech had some earnings things today that kind of dinged it. You can see it was down 4.1%. But the importance of that is that if you're tracking along with this with long-term trading positions, your stops are probably right in here. At least I would have them in here or down here around 335 to 342, and you come down to 348 on the close. You now have to manage that risk. Of course, the first thing that comes into your mind is, why didn't I sell it at 362.50 as my stop? I had it too loose, blah, 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 blah. If it's a long-term position, you have to give long-term positions room to move. So even though the stock moved $15 on the day and 4% on the downside, you're giving that a 4 to 6% breathing room. And had you had this position all the way through this, that 4 or 5% on the downside relative to the 100% you've made on the upside isn't that big of a proposition. It's actually just part of the process. What you get confused with is the time frame you're looking at. Now, if I'm in a short-term trade, which we did have some short-term trades on in this, and they were a part of this double bottom breakout right here. So we got into these trades at around 357. Our stops on these trades were actually at 360. So we ended up netting out a $3 gain, but we're out of the position. And so if it's short-term or micro-term trading, then you have to manage that risk completely different. So going back to my opening comments is make sure that your management of the process correlates with the time horizon that you're trading on, or else you're going to get, caught in some positions you don't want to be in as the market moves against you. So biotech definitely taking a flyer to the downside. That impacted healthcare as a whole. But I bring this up because healthcare has been it's been weakening is what I will say, really since the early March timeline. So for me, from a longer-term time perspective, looking at this, we've been watching this top back here and watching this kind of rolling top formation and flat top in healthcare. But you can see the rate of ascent has started to, I mean, if we were studying trigonometry, we would be calling that, a limit line on a tangent or a cosine. And what you're looking at is that it's approaching flatlining, which is never a good sign as things rise. So it either has to find some strength to the upside, or it's going to have to deal with this on the downside. So stops, even on longer-term positions, have to be evaluated relative to this. I mean, no matter what you look at, IHF, you can see the sideways movement in the providers, XPH, which are the drugs, you can see the big downward movement there today, and then IHI, which is the medical devices, even sold off, and that's been kind of the leader within the space. So a lot of profit taking in the healthcare sector on Monday relative to things out there. So you got to manage that risk. The other one that concerns us is financials moving sideways, not gaining any momentum. KBE, KRE, which are the banks, both breaking to the downside. That's another weakness within the sector. And then insurance is starting to weaken again as well. So I don't like what we're seeing there across the board. So as you go into this process, I think you're getting what this tool does for you. Now, I'm not even talking about anything other than approaching things with a proper risk management perspective, and that we're always coming in with the risk controls in mind. At the beginning of the trading week, we've done our homework. We've looked at the sectors that we like or don't like, and breaking them down sector by sector and saying, here are 10 things I like about the metals or energy or industrials or software or tech or whatever we want to talk about. And we build on that as the charts unfold. So we use technicals to go with the fundamentals so that when things happen, as they say, it's not that shit happens, it's just that things happen, and if you're prepared for them, you deal with them. If you're not prepared for them, you step in it, and that's really not what we're trying to do. We don't really want to step in it from a standpoint of seeing how things unfold. And just putting up a couple of the commodities charts to show you some of the added weakness that we're seeing in the commodities. So I would watch some of what you're seeing in the grains as a weaker issue around the markets. The dollar got weaker. Bonds we saw have weakened, but they're kind of holding on to that 129 level on TLT. All of these things are kind of warning signs that are all building out there. You can find all of this in the notes each night. Actually, every morning we post the notes relative to what we see in the research component. And my focus here is that I want you to get clearer direction in how you trade throughout the week by setting up your week. It's setting it up not to fail, but it's setting it up to understand realistically what is transpiring in the markets and being prepared for it. It's not a matter of whether you're right or wrong. It's a matter of what the market is doing relative to what you own. And if the market is working against what you own, you want to make sure that you manage the risk parameters of that versus arguing with the market. You want to manage the parameters that you have on a day-to-day basis each day so you can really control the process. So today, as we approach this, focus much more on risk parameters, risk management, money management, whatever terminology you want to give it. They all apply. You're managing the risk of the markets by having controls in place. And the most instrumental control factor you have are stops. And so use those, but also use the knowledge of things around the market, the events that are acting on the market, and understand if there are events or are they news? Are they things that have a timeline attached to them, that they have life, or are they just a flash in the pan, a news event that is going to impact things relative to what you see, believe, or know on any given day? You know, it's just like if you come into the notes on the website and you go into the trading notes each day, I'm going to address some of that. Sometimes it may seem redundant or repetitive to you when I cover certain sectors day to day to day to day to day, but every day there's something that has an impact relative to what is going on this chart. And that if we were to look at bonds today, remember we got the FOMC meeting on Tuesday and Wednesday, so bonds are in play this week relative to the FOMC meeting. Those are things that we want to know coming into the trading week as to what's on the horizon, relative to jobs reports coming out on Friday, and what's going to happen if the jobs continue to get weaker as they were last month. For March, if they're weaker in April, what does that mean? What's the potential impact of that? And each of those is very, to me, I think they're very important as you go along. And, it's just like looking at a stock like Apple, which, right, wrong, or indifferent, has been in play the last 5 to 8 days on earnings coming out. And so you have to look at that. You have to look at what the impact are on a short micro-term basis, and is your position long-term? And if so, then is there trading opportunities on a micro-term basis without worrying about my long-term position? And the key is planning, knowing what you're doing, planning your trades, planning your week, planning your emotions by not focusing on the right or wrong, but the process. So I'll leave it there. If you have questions, you can always email me, jim@jimsnotes.com. I'll be happy to answer those. We'll do more of these tutorial type things as we go along each week. So look for them each Monday to be posted in a podcast format like this. They'll be up live for a couple of days, and then they get archived, and then you have to be a subscriber to get access to those. And that subscriber access to all of the webinars and archive educational material you can access here. You can sign up for the free notes, but you also, for $200 a year, would get access to the research notes and all the educational material that goes along with it. So that's a new product that we've rolled out in the last couple of weeks, so take advantage of that as well. So have a great rest of the week. Have a great life trading. Remember, this isn't about being right or wrong. It's about managing yourself and the process by which you trade by on a day-to-day basis.